Welcome, everybody. Good afternoon, and welcome to the webinar, Uncovering Life Insurance and Long-Term Care Needs Through Tax Returns and Form 1040. I am Ana Medinaceli. I'm a director here with John Hancock's Advanced Markets Group. First, I want to thank everybody for joining today. Before we begin, I want to address a few housekeeping matters. This presentation is being recorded, and given the number of us on the line, I've also gone ahead and muted everybody so that they are in listen-only mode. Feel free to submit a question at any time by typing them into the question and answer tab. I will be answering as many questions as possible at the end of the presentation. Finally, please ensure that your attendance and any participation in this meeting is allowed under the policies of your firm. With that, let's begin. Tax Day 2019 is over. Last week on July 15th marked an important date for many of us, our clients, and most importantly for our accountants. We are done with tax filings for the year, except for those of us who have filed an extension. And while it's important to note that there was recent legislation passed as part of the Tax Cuts and Jobs Act of 2017, according to the Kiplinger article that came out last week, How Do You Compare to the Average Taxpayer? It's not surprising that most people aren't feeling a financial boost from the tax law changes. It was reported that 6 out of 10 survey participants felt that their tax burden remained the same after the tax overhaul. Most taxpayers polled also say they paid too much in taxes. And taxes also become a significant issue in retirement. So with that sentiment, I want to dive in and start going into our topic, which is the 1040. But before we get started, I want to take a moment and talk about who might be able to benefit or use a 1040 as a catalyst to start a meaningful conversation regarding the protection and the needs that they might have. So new prospects, and you'll hear me distinguish between new prospects and existing clients. New prospects obviously are individuals who come to the table and we don't know a lot about them. So utilizing the 1040 as a catalyst will let us have that opportunity to talk to them. For existing clients where we may know a lot more about them, that may not be something that we're going to explore. But last but not least, I don't want you to forget the centers of influence, especially the accountants, maybe the trust officers who we work with on a day in and day out basis. But these are individuals who we can bring to the table, maybe bring an empty 1040 and really start that conversation about what it is that we do as financial professionals in the business to helping people with their protection, retirement, and planning needs. So we have been producing the 1040 guide for 5 years now. It came out in 2015 here at John Hancock. So I've done this presentation a couple of times, and normally I go sequentially from the 1040, but today I thought I'd start with the end in mind because this is really the part where I think it's impactful, and having this as sort of a backdrop to the conversation that I'm about to have is important. So if I was sitting in front of you, and we're doing many of these through Zoom these days, is I would have you pull out the 1040, look at page 2 on the 1040, and really focus in on line 16. This line is the total tax that you, your clients, have paid for the year 2019. And when you take a look at that number, and you really sort of start analyzing and looking at it, I would ask you, and I recently asked my husband, to focus in on this line and just ask one quick question. How does this line make you feel? And I think for so many of us, we talk about our taxes, but we talk about maybe that tax refund that's owed back to us, or perhaps we focus in on how much we have to pay in taxes. But this line, for the most part, there's some credits that may offset this, but for the most part, this line tells us what our tax liability for 2019 has been. And against this backdrop is where I want to start having some of these meaningful conversations about the tax benefits, about some of the products and services that we offer. So let's keep that in the back of our mind as we sort of hone in on this. Now, the reality is that for many of us, when we look at this number, the number one thing that comes to mind is, how do I minimize my taxes today, right? It becomes about the present moment, about what can we do today to minimize that. And those conversations are important and are meaningful, and there are things that we should be doing on a day-to-day basis to try to reduce that tax exposure. But that may not be the only thing that we consider. And so the next part of the conversation that I want to have with you, as we sort of start having these conversations again with our clients and with those center of influences who we talk to, is, what do those taxes look like in the future? So not looking at it only at minimizing taxes today, but also about taking a look at the future and really considering tax diversification. So with that in mind, I want to focus on one of our more popular pieces. So the next couple of slides is based off of our tax diversification guide here at John Hancock. And what I'm going to do is highlight some of the important information from the guide to best explain what we mean by tax diversification. So let's start with tax deferral, right? And tax deferred growth is a good thing. So when we look at this chart, we see a $10,000 investment, and we look at it over a 30-year period. And what you will see is, due to the compounding and tax deferred nature, you'll see that that account after 30 years is worth $57,000. If you take that same account and over that same period of time, look at it, but you tax it at a 20% tax rate, which would normally be capital gains tax rate, you're going to see the impact of that. It's $40,000. Now, if you consider that being taxed at what we consider ordinary income tax rates, and we tax it at the highest rate that we think possible, which is 40% at this point in time, that's going to come down to $28,000. It's almost half of what that original tax deferred investment may be. So this chart helps explain why tax deferred growth is something that is important, but again, doesn't tell the entire story, right? It doesn't tell us what happens at time of distribution if we are taking that money from a pre-tax account like a 401k or an IRA, but really a good and poignant conversation to be had. The other thing that I want to focus on is taking a look at the history, right? When we're looking at sort of the highest marginal tax rate and go back from 1913 to where we are today, you can see that tax rates are cyclical. And, if we had someone who retired back in 1990, which was arguably one of the lowest rates in recent history, you'll see that there was a cycle that went up, sort of became stagnant, has gone down, come up, and stagnant. So the main point to consider is that when we are planning for future taxes, it's a variable that we don't really know what may or may not happen. But again, for those clients of ours who are in their retirement or in their working years, we know that there's probably a certainty that it's going to be cyclical, and taxes are going to go up and they're going to come down. And so when we consider that, we have to factor that into our planning. Which leads us to this whole notion about tax diversification, why it's important. Again, this is taken directly from that piece that I mentioned at the very beginning. And this is a very simple example, and it analyzes just taking a look at it from a withdrawal perspective. So if we have a client who's going to take $120,000 withdrawals, and we assume that they're only going to take that from a 401k plan, that $120,000, because it's subject to ordinary income tax in retirement, is going to come down to $78,000. That's going to be the net amount after tax that they're going to get. But what if instead we took that $120,000 and we broke that up and did $40,000 withdrawals, $40,000 coming out of the 401k, $40,000 coming out of a mutual fund account being subject to capital gains rate, and then $40,000 coming from a tax-free account. In this instance, it's a life insurance policy, but could also be a Roth IRA. Well, when we do that and we do the math and we do the taxes, you're left with a potential net income of $100,000 as compared to $78,000. So it gives us the case for tax diversification. Now, you compound that with, again, remember at the very beginning, we were talking about how to minimize taxes today, but also looking at the distribution and the retirement side of the house. How can we help plan for the future? And so this is where, against that backdrop, against that line 16, I think it's important that we now focus in on what permanent life insurance can offer. And this is really the case for permanent life insurance. We here talk about the tax-free death benefit, and I think that against that backdrop, we can realize what that really means, right? It means that if I have a life insurance policy and I leave that to my husband and I have $1 million, let's say, that $1 million is received by my husband tax-free. There are no taxes eroding the purchasing power of that death benefit, providing the financial security that my family needs and that I want to provide. But in addition to that, the other great part about it is that we can create some of these accumulation type policies to be able to afford us tax-free access to cash value. And again, for that future growth and for that future need that we may have. So when we're talking about supplementing retirement income, when we're talking about building in some of the flexibility that some of our products and services that we offer, that's what we want to focus on. And again, when we use that line 16 as sort of that benchmark to really hone in and talk about why taxes matter and what we can do not only today but in the future to help mitigate some of those taxes, I think that gives us a really good opportunity to talk about some of these tax-free benefits. And I will sort of give you we're going to jump into now some of the other conversation starters with regards to 1040. But I do think that it is really important that when we're talking about that tax-free nature, that again, that backdrop works into it. But I also reference it, again, now I'm going to go sequentially through the 1040 and some of those schedules. But Schedule A, and I'll point it out when we get there, also combines state taxes. Because again, line 16 is the federal income tax that we pay today. But that's not the entire tax story, right? We have state taxes that we have to factor in. And so Schedule A might give us some insight into the additional taxes that we and our customers are paying. And again, against that backdrop of a tax-free nature, can help us really elevate and have meaningful discussions. So now let's start talking about some of the other ways to use really the 1040 to start meaningful conversations. The one thing that I'll note is I know, taxes can be personal, and so it may be that you have clients, prospects, and unlikely accountants will bring in, their own tax returns, but you can utilize, again, a 1040 just as the catalyst, even without any numbers attached. And here's some of the first thing that sort of sticks out to us, the first question being asked by the 1040 that gives us some insight into how we can help prospects and really help those accountants understand what it is that we do, is to talk about the filing status. Many of us know that, if you have an individual who gets married, they, because they now have a spouse and someone that they love and want to support, are going to want to reanalyze and look at their life insurance needs. And so those become sort of those triggers that really we talk about, marriage, birth, adoption. Those are things that sort of we know as practitioners to really talk about why individuals would want to analyze their life insurance needs. But just as important as it is to analyze those moments, it's also important to look at some of the other underlying things. So if you have a client who maybe has changed statuses, so if you're able to compare, different tax years and you see that they were married and now are single, or even single and now married again, those types of conversations can lead to other things like, if you have someone who is divorced, and we'll talk a little bit more about this when we look at Schedule 1, is to talk about, does the divorce decree require life insurance? And what have you done to take care of that? And if they've purchased life insurance, would they like a policy review? And if they have not done anything, what can you do to help facilitate that? And so again, that's something that can be started off with this. The other thing to consider is if you have someone who is married for the second time, blended families in terms of liquidity and in terms of being able to provide not only for their family today, but also looking at their blended family as a whole and looking at some of the intricacies involved with what that plan looks like and what do they want to cover and what is that legacy and what liquidity do they need. And so you can have those meaningful life insurance conversations then. And last but not least, if your client is listed as head of household, means they typically have a dependent who relies on them for financial support. Again, it doesn't mean, you may have someone who doesn't believe in the institution of marriage, and that's fine, but there are, again, some planning challenges as it pertains to not only their life insurance needs, but making sure that their estate planning documents, their wills, their trusts, their healthcare proxies are all up to date to reflect what it is that they want, versus what the law allows for them to do. So without a plan, the state comes in and tells you, what that looks like. And again, it becomes important to really analyze and look into that. And last but not least, it's looking at, those single families who have a head of household, single parents who really need to take care of those dependents who rely on them. So, which leads us into our second part of the 1040, which is dependents. Again, as I mentioned before, one of the triggers for, looking at life insurance and the needs that life insurance brings to the table is birth or adoption of a child, which would be reflected on dependent. Don't forget, though, that even if this line is blank, and this isn't only specific to this, but to many of the lines that we're going to go by with the 1040, even if it's blank, does not mean that they don't have a 1040 that they account for. So it's asking those questions. Do you, this line tells me about the dependent. Can you tell me, does anybody in your family require on you, and what does that look like? And if you have a blended family, and tell me more about that. And so I think it's about sort of having those conversations. This question too, I'm part of this generation. It's that sandwich generation where, we usually think of dependents as our children, but oftentimes, and you can see it time and time again, is that the older generation becomes dependent and requires financial support. So again, even if this line is blank and no one is listed, here's an opportunity to talk about the protection needs and to talk about, do you have, family members who may rely on you in the future? And what does that look like? And what does that mean to you? For those of us who have had personal experience in taking care of that second generation, for us, that legacy may mean that we want to plan for the future, and we want to make sure that our children aren't burdened with having to take care of us. So this, again, is a really good point to sort of take a breath and to talk about it. If you're talking to accountants, you can again say, I have many individuals and clients who've had to list their parents as dependents, and I'd like to share more about, what some of the alternatives are. And it gives you that opportunity to talk about planning and long-term care planning. Because again, sometimes the best legacy that you can leave to your children is to not have to take care of you. And you can have that conversation in this line about how that legacy can be sort of protected and what you can and can't do. So really good conversation starters, and right at the offset with the 1040. So now let's focus in on that second half. So if you're looking at a 1040, the second part of the 1040 really dives into the income. And I'm going to break this down into two different prospects. So the first individuals that I'm going to talk to are those who are the income earners. So they're likely going to have wages and salaries on line 1, and perhaps line 7A from schedule 1. So if they have business income or rental income, they're going to have income there. And again, when we consider what we need from a life insurance perspective, one of the two things that sort of always come to mind is you want to be able to replace income. And that's, rule of thumb is you take some multiplier, multiply that, 10 times your salary, and that's what you need for life insurance. And sort of that's a basic needs analysis. Here, we can have that conversation. We can say to that client, hey, your wages for 2019 were X. How much of that would you like to benefit for your wife, your husband, your children, and really start talking about what that means. It also can help us understand sort of the disparities. So maybe you have one that's a high income earner, and maybe you have someone who's a stay-at-home spouse. And so the stay-at-home spouse is not necessarily going to have sort of that replacement of income, but they're going to have more of dependent care. So I think, again, this gives us a really good opportunity to talk about the needs analysis. And since income is such a great factor when we determine life insurance, I think that this is definitely a really good conversation starter. I will also give you a preview. And again, the 1040 and all the various schedules don't work sequentially. But again, if I was having a conversation either with the prospect, the client, or the accountant, I would talk about the income replacement. And then I would, again, when we get to it, I'll talk to you about Schedule A and the debt replacement. So income and debt are generally things that we want to, as individuals, account for when we're considering how much life insurance we need. So those are our income earners. But what about for those individuals who maybe are pre-retired or who are retired? And you'll see many more of these lines filled in. So you'll probably see lines 2, 3A. So you have municipal bonds, you'll have qualified dividends, you'll have capital gains in line 6. You may even have IRA distributions. So for those individuals, anytime there is something within these lines, you can start asking and probing about what that asset is for. So for example, if I had a large IRA distribution in 4B, I may ask the question of, I noticed that you had a large distribution from your qualified plan. Can you please tell me more about that? What is that asset for? And do you need it for retirement income purposes? And I would sit there and I would listen to the client and to the prospect, because what we ultimately might hear is that they may not need that asset, that asset is really meant from a legacy planning perspective. And especially with qualified plans, we can then start talking to them about what that means. What does it mean if your children or grandchildren inherit that IRA? It's an account that's grown tax deferred, but will be taxable to your children. And now we have limitations on how you can stretch that. If that required minimum distribution is causing you angst and you don't need it and you don't want it, what are some of the opportunities that we can do to sort of leverage that and really leave that legacy that you work so hard to, right? I think a lot of people are shocked not only at the taxes that they paid, but when they realize that the legacy to that next generation may be impacted by taxes. And so again, it's having those meaningful conversations, and you can do that in many different places here on the 1040. So really good place to sort of start talking about those legacy needs. And again, if you have someone who's sort of on the younger side and needs income replacement needs, we can have those conversations here. So Schedule 1, I talk a lot about the Tax Cuts and Jobs Act, and that sort of, I think, came and was a significant change in tax reform, right? And one of the changes was that the 1040 used to have all of these different, it was longer, so in many respects it is a lot simpler, but now we have different schedules. So I'm going to focus in on Schedule 1, as Schedule 1 talks to us a little bit more about other types of income. So I'm going to start with either alimony paid or alimony received. And again, that's in either Part 1 or Part 2. Going back to the filing status. And so at that point in time, we may not have, tax returns to compare to, but if you see this, again, this is a place where you can, if you see something within these lines, you can then correctly make the assumption that they've been divorced and that's why they're receiving alimony or they're paying alimony. And it gives you that moment to have that conversation with the prospect and talk to them about the divorce decree. If they've been remarried, what does that mean, and how does that blended family, and what does that legacy that they want? And so, again, if you're not comfortable talking about it, at the very beginning of the 1040, here's an opportunity to really dive deep and talk about that here. I think most importantly, and where I want to spend a little bit more time though, is on the business side. So line 3 here is business income, and it's coming from Schedule C. This is for pass-through business owners. So I do want to mention that if you have business owners who file their C Corp or they have different tax filing forms, and we'll get to that a little bit at the end of this webinar, but generally, a lot of business owners probably will fall into this third bucket. And even if they don't, and you know that they're business owners, it gives us an opportunity right now to stop and talk. And I think the best thing to do is to have that individual and that prospect tell you about the business. The business planning market space is vast. There is a lot that we can do from a planning perspective. Business owners have their own individual needs that they need to take care of. But in addition to that, they may have succession planning needs. They may need some buy-sell type of planning. And again, this is all of the conversations that you have. Do you have partners? Who is the next in line to inherit the business? How is that succession going to take place? They may have employees that they want to retain and reward, or they may have a key employee who's really part of that business. So right here, line 3 gives us the opportunity to have that conversation, to talk to the client about their business, and to really have them tell us in their words, what's keeping them up at night? What do they need? I'll tell you, and again, I've been using my husband as an example throughout this webinar, but my husband is a business owner. And the one thing that I think our current environment has led to is that there's a realization that there is, my husband was sort of, head down deep into his business 10 years later, and there was nothing stopping him. And now we've had a lot of conversations about the what ifs in life, because it's sort of that uncertainty that we are moving forward with. And so it's a really good time to talk to those business owners about what their plans is, what is keeping them up at night. And remember, businesses have been affected differently. You have businesses who actually are thriving in the current environment, some that are doing okay and some that are not. So it's being sensitive to their needs. But arguably, there is an understanding in this community that there needs to be proactive help to protect their businesses, to protect their families, and to take care of those needs. So really good opportunity to discuss those needs for that. In addition, the Schedule 1 will also include both rental real estate and farm income. And like business owners, it's the same type of conversation that we're having with these prospects and these clients. But more so with the rental real estate and the farm income, taxes, and farms get some tax breaks. And so they really understand sort of that. But liquidity, and liquidity and legacy planning become a really big issue. And again, I don't like to overgeneralize, but when we're in this market and we're talking to these individuals, not only liquidity for today, but liquidity, from a succession planning perspective, and how do you do that? Because these assets aren't necessarily easily dividable. So from an estate equalization, from that legacy perspective, we can have meaningful conversations there as well. And last but not least on Schedule 1, and many times you may not see that there is any, that it's blank, right, is the IRA deduction. And that is here on Part 2, it's line 19. But here's the thing, even if this is blank, I would take a step here and talk to that client about their retirement readiness. And so have they considered doing an IRA? Why or why not? What have they done from a retirement planning perspective? How do they feel about their retirement? Are they maybe too invested in those pre-tax accounts and are going to be subject to those taxes? So this is a good conversation to have, even if that line is blank. And again, part of that Schedule 1. So let's move ahead with Schedule A. Schedule A is a schedule that today, because again, the Tax Cuts and Jobs Act has doubled the deduction. This is one of those schedules where it would be helpful if individuals haven't filed or currently aren't filing this to maybe compare and go back to a year where perhaps they filed the Schedule A, or even bring up a blank one. I'm going to come back to the medical and dental expenses one. I think that this one, I want to spend a little bit more time on that. But quickly, I'm going to go through some of the other ones. Taxes you paid. I mentioned when I was talking about line 16 that that's the federal income taxes. The taxes you paid section here is going to give you an idea about your state and local taxes, as well as your state real estate taxes. So when you combine sort of the taxes that you paid on a state level and the taxes that you pay on a federal level, again, that gives you that conversation to be had about what can we do from a tax minimization, tax diversification perspective. The interest you paid, so looking down a little bit down here, again, this is going to give you a sense as to what their mortgage is. It's not going to give you the entire conversation, but from here you can ask them, again, similar to that income conversation is, can you tell me a little bit about your mortgage? How long do you have? Is this something that you would like to take care of if something were to happen to you? Because remember, income and debt are the two factors that are usually put into a needs analysis to help us determine how much life insurance we want covered. So good place to sort of have that conversation. Gifts to charity. If you have clients who are charitably inclined, this line gives us the opportunity to talk to them about their charitable planning intentions. A lot of times, many individuals, as part of their legacy planning goals, want to benefit a charity, whether it's their alma mater or their charity that they love. And especially for those high net worth individuals, we can do some really great planning. There's CRTs, there's a whole bunch of charitable planning things that we can bring to the table and opportunities and solutions, but you have to have a client who is charitably inclined. And so again, this gives us the opportunity to say, Mr. and Mrs. Client, can you tell me about your favorite charity? Is this something that you would like to build into your legacy? And from there, we can build in those conversations and then ultimately bring solutions to the table to help them with those legacy planning goals for the charity. But now I want to sort of come back in and really spend some time on the medical and dental expenses. Again, this is a line that is often left blank. The formula in order to be able to deduct medical and dental expenses, it's a hard benchmark to beat, right? And so many times you'll see this blank, right? But again, it gives you as the financial professional to say, medical and dental expenses are one of those items that a lot of individuals are now concerned and are becoming more concerned so in retirement. Can you tell me your thoughts and your opinions on medical expenses in your retirement? And then listen. And I think there are a couple of different things that are going to occur from that conversation. One, you may find that the client opens up to you about their own history. And again, when we're talking about life insurance and long-term care, that many of us know we have to go through that medical underwriting, right? There are certain things that we have to know. And so it gives us an opportunity to listen and to really understand if they're willing to give us that information that sometimes it's hard to come by, right? And we don't want to assume. So that's the first thing that comes to mind. The second thing that comes to mind, and we've covered it a little bit again, is talking about how medical expenses, especially in retirement, can become so burdensome. And we can also then have that opportunity to engage with the client, with the accountant, and offer them sort of that conversation about what is and what isn't considered a medical expense, and how a lot of times long-term care expenses are not paid by traditional Medicare, and what that means and what that ultimately can impact that portfolio. And again, I look at today, and you look at today, and if someone needed a long-term care, they're going to have a high cost. Markets are volatile, so you may have to, take assets, that have been depleted by market volatility, and it just becomes this perfect storm where your financial portfolio is impacted and could be imploding. And so from that perspective, it's taking a look at what are some of the options available to the client so they can perhaps transfer the risk, or if they're assuming the risk, what does that mean and what does that look like from that? And then the other thing, and I think that this is also important, is, and I hear about it all the time, whether it's the news or your friends, wanting to live a long and healthier retirement, right? And I think again that's sort of been broadcast. It's not only living a long retirement, but a healthier retirement. And what are we doing for that? And I just want to spend a moment and really talk about John Hancock, because John Hancock, through their Vitality program or through the Aspire program, which is for individuals who are living with type 2 diabetes, this is an exclusive program to us where we're able to offer those who want to engage, rewards and discounts for living a healthier life. And again, it's something that puts us on the same side of the table. It's something that we can listen to when we're asking this conversation. And it really helps benefit and sort of helps us sort of align with those clients' wishes and goals. And so for those of you who want more information, I would encourage you to reach out to your John Hancock representative, because I do think, given where we are, given the environment that we're living in, it's becoming something that's important not only to us, but to the clients that we serve. And so it's another important discussion to be had. So lots of good stuff can be had from really looking at those lines within the 1040. But the 1040 doesn't tell us everything. And so I can't cover all the various schedules that are out there. So I just want to end this with talking about some of the different iterations and some of the other things to look out for. 1040 for non-resident aliens, the NR. The foreign national market, again, it may not be applicable to all of you, but there are very specific rules and regulations with regards to non-residents and especially as it pertains to transferring wealth and gifting and estate tax exclusions. And so for those, I would encourage you, if you have any clients who fall under the spectrum, to really understand this niche market, right? Because there are very specific standards for them. The other thing is for those individuals who file trusts, again, if you have trust officers and they're filing Form 1040, trusts are really interesting because they hit the highest income tax rate at a very low income benchmark. And I'll give that number to you. So in 2020, a trust will hit the highest tax bracket at $12,950. Consider this: if you are married filing jointly, in order to hit that 37% benchmark, you need to have earned $622,000. So $12,000 versus over $600,000. So for trusts, and again, trusts are, they're a little bit complicated, but if you have an instance where you have trusts, there may be opportunities for us to, again, help with that tax mitigation, help with that opportunity to bring, life insurance to the table. And again, it's going to be dependent on what's within the trust and all that, but just consider that as we move forward. And last but not least, here are the forms that you would see from a C Corp, an S Corp, or a partnership or a business. I spent some time talking about it and very passionate about the business planning market. And so again, if these individuals are filing this, it's not necessarily about what's in these returns, but it's more about what is keeping them up at night? How can we help them? What are their goals? And how can we align to those goals to really bring those opportunities and those conversations to light, to really help them with their planning objectives? So lots of really good stuff. So did you ever think that you would spend 40 minutes talking about 1040? But here we are. We're nearing the end, and I'll open it up for questions in a minute. But we have a lot of tools here at John Hancock to help. I've spent significant time talking about needs analysis from a life insurance perspective. We have an online needs analysis calculator that's out there. We also have a Know the Law map. States literally vary all across the map. And so in order to best understand state estate taxes, income taxes, and creditor protection, we have this Know the Law map that will give you, whether you're in California, New Hampshire, or Massachusetts, it will give you a breakdown of what those state-specific laws are. And finally, Business Analyzer is our interactive tool to help business owners find the right plan. As I mentioned, this is a vast market, and it's really going to be dependent on the needs and wants of the business owner. So in order to help facilitate that conversation, we have that available. And last but not least, I am blessed to be part of this John Hancock Advanced Markets Group. We are a group of attorneys and consultants who are here to help you, whether it's case design or answering questions that you might have. We are here to help, and this is the best way to reach us is 888-266-7498. Option 3 gets you to a consultant. Option 4 gets you to an attorney. So if there's anything that we can do to help partner with you on your next case, that's what we're here for. So with that, we are coming to an end, and I am going to stop the recording.